fractional reserve is a fraud. Fractional reserve is the cause of recession. I have heard this so many times. In today's video, I want to challenge that point, and I want to do this by sharing with you a class that I have provided to the students of the Academy. So without any further ado, let's get straight into the video of today. This is a presentation that I have made for the Crypto Vagabonds Academy. If you would like to join, please consider joining with the link below. But today I'm going to explain to you guys about economical cycles and how they work, what they are, and how fractional reserve is not what causes economical cycle. And I want to do this presentation with you guys, and I want to go through the following roadmap. First, we're going to be talking about what are economical cycles. Then we're going to be looking at the individuals that play a role on economical cycles, such as the creditor, the investor, and then we're going to be talking about what is maturation time or maturation date, and then we're going to go back into the definition of a recession. So let's get into that. So what are economical cycles? Economical cycles are irregular, recurring fluctuations of the economic activity that happens globally and or locally. So in this graph, I want to move my mouse here and try to show to you guys, all of these gray columns is pretty much a recession. Every time you see a gray column is pretty much called a recession on this graph. Now, the reason I'm showing this graph on the GDP of Brazil is because, as you can see, the recession may occur globally or locally. The previous graph shows a recession that has occurred in the US. Now you can see here that Brazil didn't really have a recession or much of a recession in 2008. The recession in Brazil was delayed. It came in 2016. Recession can happen globally or locally, as we can see here on the graph on Brazil. Now, when the economy is expanding, when everything is going well, that also is called good liquidity. And as I move on, we're going to cover it and you're going to understand why it's called good liquidity. So why is it called good liquidity? Let's look at the players of this recession or this economical cycle. First, we have the creditor. And the creditor is a person who saves money to lend out at interest with a specific deadline. So in this case, I use a character that we all know. And the investor is the person who borrows that money to invest on an enterprise. In this case, we have a guy here who wants to plant tomatoes. So of course, the amount of time required for him to build his structure, plant the tomato, harvest and sell, that would be called the maturation time. And we're going to be using the maturation time of the tomato. So he's taking a loan to plant tomatoes and to pay when the tomatoes are ripe. So here we have, just to recap, we have a creditor, we have an investor, and we have the enterprise right above me here. And the reason why I put the color not as bright is because the idea is still on the head of the investor. It's not very mature or very solid yet. It will become more solid when he gets the money from the creditor. And you can see here I already put the color a bit more strong because from the moment that the investor is receiving the money from the creditor, the possibility of his enterprise going well is increasing. So here we have the creditor handling money to the investor, and the maturation of his idea or the maturation of his enterprise is becoming stronger. Now, of course, on a perfect economical cycle, he would have now planted, made his enterprise, harvested his tomato, sold his tomato, and then you can see he has here some money that he got from that tomato, and a portion of that money is to pay the creditor. So as long as the economy is going like that, we call that good liquidity, expansion time, or just economical growth, which we have here the illustration of good liquidity. Now, of course, that good liquidity cannot go on forever. Eventually it has to peak and then has to go down. And this peak here is what we call in economic language the crisis. And of course, with the crisis comes the deterioration of liquidity. Let's look at what is deterioration of liquidity. So deterioration of liquidity is a time mismatch, is when the person who is investing on an enterprise cannot fulfill the commitments and pay their loans or pay their debts on the maturation date. That mismatch in time or deadline is what causes the deterioration of liquidity or the recession, because the needs of the creditor versus the investor's ability. Cash flow from investors does not match the expectations of the creditors, and that causes turbulence on the economy. So let's look what that looks like. Let's replay our story. Here we have the creditor, the investors, and the idea not really mature on the head of the investor. Now, just like before, the creditor gets money from the investor and the idea becomes a bit more solid. Now, let's say something happened. There were plagues on the tomatoes. The investor could not harvest his tomatoes. Therefore, he cannot make his payment due to the creditor. That's why I have those X's, meaning the creditor now does not have his money on time. And what will happen is that creditor now would become a bit more stingy, or is going to put higher interest, or is going to be much more restrict of how much money he would lend out into whom. So once money is not as easily acquired, we call that a crisis or deterioration of liquidity. So the recession is extremely necessary to clear more investment, because if the creditor keeps giving money to everyone who wants to make investment, if the investment doesn't go correct, then the creditor does not receive his money, and if he continues to do that, eventually he's going to run broke. So the recession is extremely necessary. So again, irregular recurring fluctuations on the economic activity globally or locally. That is a recession. Now let's look at the role of the central bank. And for the sake of this story, and again, this is a very oversimplified explanation of recessions, let's look at central bank. Central bank, for the case of this narrative, let's call the central bank an entity with monopoly on an infinite amount of liquidity, which means they can just create money out of thin air. There's no limit to how much money they can create. And of course, the man right here behind me is the man that has a monopoly on an infinite amount of global liquidity, because the US dollar, after all, is the currency that we use globally. And this is now our creditor. Remember, now, because he has an infinite amount of liquidity, then that means he can just print money forever. Now, what does that do to the economy? So let's look at how false liquidity works. Because remember, Jerome Powell did not have to work or save the money. Central banks don't have to save that money. They can simply create money out of thin air. So now the creditor has the investor, and the investor now is having an infinite amount of liquidity, and the maturation of his idea is there, because it doesn't matter how many mistakes he makes, or if there's a plague on his tomatoes and he doesn't manage to harvest, he will always have liquidity. Of course, that is a problem for the real creditor, those who really have to work hard, save money, and loan that money out. Because what happens is the central bank, because they have an infinite amount of liquidity, they can keep interest rates very low, and that is really hard for those who do not have the infinite amount of liquidity to function on that market, and that causes distortion on the market. Of course, it promotes and intensifies this temporal mismatch, and it makes almost impossible to read the economy. And that's why our creditor in that situation with the central bank, he seems to be very concerned. Because after all, the central bank can create what we call nominal assets. Assets that can be created without any effort. Those are nominal assets, which are very different than real assets such as gold. Gold has an inherent value to it. When you see a bar of gold, you can tell that that gold was produced with hard effort. Now, false assets is one way to mention, or nominal assets, but remember, are assets that are created without any effort. And in my view, those are liabilities, because they are created without any effort. Now, as I mentioned, gold is the real asset because it takes effort to be created. Assets that require effort to be obtained are real assets, such as BTC. BTC cannot be created out of thin air. BTC requires a huge amount of electricity. It requires the equipment for you to buy. It requires cooling those equipment. So when you buy a Bitcoin, you can tell that Bitcoin was produced with effort, and that's why the price of Bitcoin it is so high, because it takes a certain amount of energy to produce. And if the price does not manifest or does not cover the expenses of the miners are very unlikely to sell those Bitcoin. They may actually shut down their machines and so on. So we need to acquire assets that have inherent value, has been taken effort in order to produce those. Again, I see a central bank as the liability issuer, because what happens is if the central bank continues to issue money continuously, what happens is that is inflation. The more supply of money we have, the less value that money will have. So our Jerome Powell cannot produce or issue money forever. That's why right now he's increasing the interest rates, because he wants the investors or those who took money as a loan to bring money back to the coffers, because the consequence of continuously issuing money is to become Venezuela, where it takes billions of Venezuelan currency to buy one roll of toilet paper. Once that happens, once the issuer stops issuing money so fast and makes harder for the investor to get their money, that's the beginning of the recession. Remember, on our first narrative, our creditor did not want to loan once the payment was not there. But this whole thing affects everyone because it distorts the entire economy. So it is not fractional reserve that caused the recessions. It's pretty much central banks. And now I want to pause and explain to you why it is not fractional reserve that causes recession. And the example I want to give to you is this. Imagine that I am a bank and you're my only client and you have just won $1 million in the casino or in the lotto. And you come with that $1 million to deposit with me. What happens is you open two accounts. You open an account with $100,000, which is a checking account, and you also open a savings account where you put $900,000. Now, the $900,000 I have to pay you interest because it is on a savings account. If I take that money and I give that out the following week to someone who wants to mortgage their home, I acquire their home, and let's say their home is worth $2.5 million. Notice that I have an asset that is worth $2.5 million and I have now given that person only $900,000. This is pretty much almost 3 times the amount that I have given to them. So I'm not fractionally reserved, I am over collateralized. Now, if 3 months later you need your $900,000, I don't have it to give to you. However, I am not fractional reserve. I am in fact over collateralized, and that's because there's a difference in liquidity. The money is instant liquidity and your deposit on a savings account is instant maturation, but the house that I acquire will take a long time for me to sell, meaning lower liquidity. So let's make a recap on what we discussed in this video. We discuss what are economical cycles, we talk about good liquidity, the duration of liquidity, and how important is the recession so that people can fix their mistakes or their malassessment on investments or loans, and what role the central bank play in causing recession. We also talk about nominal assets, real assets, and the issue with infinite amount of liquidity, and also we discuss the difference between liability and assets. And also towards the end, I explain to you how fractional reserve does not cause a recession. So that was it. If you do want to know more about this, if you want to learn more about economy, please consider subscribing to the Academy using the link below. If you do not want to be part of the Academy, but you want to be exposed to more content such as this, please smash the like button, also click the notification bell and subscribe to the channel. And if you do know someone who can benefit from this kind of information or this kind of content, please do share the video. This is it for now. See you guys on the next video.